Great to see you both. Jason, you first, because you got money on the line here. What do you think?
I do, Scott. And I think for me, as it relates to the ad business, I think Netflix is in a really interesting spot. One, obviously the ad business has been very accretive to the business and everyone is excited about that piece. But it only represents 5% of their revenue. And if you think for a moment that we're heading into a recession or maybe that we are already in one, at the end of the day, there's only 5% exposure to the ad business, which potentially, we know ads go down 20 to 30%, when folks are changing behavior in a recessionary period. So I think where they sit is a very interesting place where we know it's poised to grow, but where they are currently is a nice spot where they're not overly exposed. And then, as it relates to the content slate and the quarter that they had last quarter, 16% revenue growth. Obviously, they're not going to be reporting subs this potential quarter. So there's a lot of focus on engagement and profitability, which I think they have been focused on distinctly over the last few quarters. So I continue to like the name. I think this will be a nice report, and I think it will be set up for the rest of the year.
What do you think, Alex?
Well, incremental ad revenue and a small percentage of your revenue is nice, but I think Netflix is counting on more than just incremental revenue increases from advertising. What Netflix has seen with advertising is 55% of new accounts created in the areas where it offers advertising have been on those ad plans. So you're seeing people pay less per user when it comes to an ad plan, but you might be heading into a moment where selling advertising is going to be tough. So I agree with almost everybody that's been on air with you in the recent days that Netflix is resilient in an economic downturn because people are going to hang on to these subscriptions. However, I don't think that it's going to be completely unscathed here.
No, but you could go from, let's just say you're at a top tier plan, which is much more expensive than the ad tier. And you say, well, you know what, I'm a little bit more worried about the economy, so I'm going to drop down. So Netflix sees a pickup in a key part of their business that they'd like to see a pickup, but then there's an impact on overall revenues, too, because you're bringing in less per customer.
Yeah, it's actually happening in this moment where Netflix is stopping to report subscribers and starting to report revenue, so we could see the revenue hit. And by the way, we just had the NFL in December, so in the last quarter, in quarter four, and now we're looking at Q1, no NFL. And I think the note on churn really makes a big difference. So you could see both churn because people are like, no NFL games in Q1, I'm out. Price hike, I'm out. Or maybe I'm downgrading to an ad tier, which Netflix has less ability to monetize because we're going to go into a moment where advertisers are going to spend less. I'm not saying it's curtains for Netflix, but it's definitely a more challenging time. And we've seen the run up in the stock compare like almost 10% up this year compared to almost 10% down in the S&P 500. And we're in an earnings seasons where people are going to expect a lot out of Netflix if it's seen as the safe haven for the tech trade.
Right, Jason. We're going to move. I mean, they're moving. So, investors are going to have to move, too, from total number of subs to how they're monetizing everything. That's going to be the most important thing going forward, is it not?
There's no doubt about it. I mean, engagement, and I think it's an important point that you already made about trade down. Obviously, the lower subs are not nearly at, the margin is not nearly there as far as a premium, but there is an ability to trade down, which I think is a separator from them and the rest. The other thing that I think is important to note, this is a $650 billion TAM. And Netflix only owns 6%, of this huge TAM. So I think there's a lot of opportunity ongoing. They've obviously pulled the levers in a lot of solid spots. Yes, there hasn't been any live sports, in Q1, which I think we'll see some of that in Q1. But going forward through the rest of the year, I think there's some plans for some licensing and other opportunities that I think will be accretive to the stock. So, again, this is why we continue to like it. It has been resilient for sure, and I think it will continue to be so through the rest of this year.